thanking Brookings and Shamika in particular for inviting me here. Great to be here. I wanted to actually get my copy of Surjit's book, which is lying in my bag out there, and first compliment Surjit. I think what you heard today was an epitome of a much larger narrative in his book, a wonderful book, thought-provoking, very analytical, a must-read for everybody. So, congratulations on a great piece of work. But I will be failing in my Hippocratic oath if, as a discussant, I'm a cheerleader. So I'm going to hopefully offer a constructive critique, Sajjid, mainly because you've written that you want to take this into an academic paper based on the feedback. So hopefully the idea is, just to offer some constructive critique for the next revision. So as I mentioned, on chapter 7, where this comes from, I think it's very thought-provoking and very ingenious, because so far, people talk about globalization, but globalization has always come to kind of epitomize, low value-added manufacturing goods flooding the world from China. So it kind of, what was embodied in those goods and services were low value-add, low skill. It came to symbolize technological injections in the world, capital. But what Surjit does quite very, very cleverly is now talk about the value of high-skilled labor. And I think that's really the main contribution of this chapter and of this book. So what I'm going to do is try and address two issues here, because I think there are analytically separable issues, what Surjit brings up. The first is the role of what he calls unlimited supply of skilled labor in this great inflation decline, and talk about that role vis-a-vis other hypotheses. Surjit spoke about some of these: slack, inflation expectations, oil prices. And then the second question is a slightly different one. What is the outlook for inflation? As he provocatively asked, is inflation dead? Because these could be different things. You could well have the unlimited supply of skilled labor playing a very important role in explaining inflation heretofore, but that doesn't necessarily mean that inflation is dead going forward if some of these forces were to reverse, right? Let me start by digging deeper into the data, right? And Sajjid, here, I think we need to separate, and you've mentioned this in the book, but not in the presentation, headline inflation from core inflation, right? Because as Sajjid says, all of the dynamics that he's talking about, wages, really affect core. It don't affect food or fuel or what OPEC does. And I would venture to say that there are different things going on. I'm not sure if you can see the chart there. If you look at core inflation, starting from 1991, about 30 years, there seems to be two different dynamics at play. It is undoubtedly the case that in the 1990s, you saw this massive disinflation in core, and I'm going to talk about that. But if you draw a line somewhere around 2000 and project forward, what you see is core inflation remains remarkably sticky, right? This is a weighted average about 60 countries, 35 advanced economies, 30 emerging markets, very close to the definitions that the World Economic Outlook looks at. And what you find is core inflation remains remarkably sticky, right? Yes, there is a V-shaped decline after 2008. It bounces back. Maybe the levels are a little bit lower in the last decade. But if I started the analysis in 2000, I won't say that there has been this secular decline in core inflation, right? And the reason I'm saying that is if you look at headline inflation, you get a very different picture. You get the picture that this is a secular decline over 3 decades, and you need some phenomena to explain that. But if you go back to core, the picture is a little bit different. And Surjit, this is all from a perspective of how to improve the paper in the next version, right? So number one, if you look at that, you get a slightly different picture of the dynamics of inflation. So now let's separate this out. I think there are different decades and different dynamics at play. In the 1990s, Surjit is exactly right. You see this very sharp, broad-based disinflation. It's in the global economy, it's across advanced economies. But as I mentioned, in the 2000s, you get great stickiness. Yes, it is true that advanced economy inflation, as Surjit said, is consistently below 2%. And they're unable to hit their inflation targets. But it is not true, prima facie, that this decline, this secular decline, continued even before the global financial crisis or after the global financial crisis. And if anything, the momentum of core inflation, I'll talk more about this, has actually picked up in the last 4 or 5 years if you look at this stuff very closely, right? So let's first look at the 1990s. Now, I'm going to offer an alternative hypothesis of what was driving inflation in the 1990s, and I'm doing it mainly to provoke Surjit into formally controlling for these factors in his regressions, so that he's got a kind of ceteris paribus argument here. Well, we know what happened in the 1990s. On the one hand, you had the Great Moderation. There's been a huge literature on this. I would urge everybody to go and read Ben Bernanke's work in 2006, where he talks about the Great Moderation, which is the fact that you had, runaway inflation in advanced economies in the 1970s. Paul Volcker came into being the Fed chair. Sajjid talks about this in his book. And real rates in advanced economies were very, very high. So the left-hand side chart is the real policy rate in advanced economies. And what you find is that this is, running at 4% compared to a real rate of minus 4% in 1976 or thereabouts. Weighted average across advanced economies. So there's a 10 percentage point swing in real rates. You know what? That is going to cause inflation to come down. Monetary conditions that tighten dramatically, and you see that in inflation expectations. Right? Look at inflation expectations. This is the University of Michigan survey. They're running at 1 year ahead or 10 years ahead, running at 10%. And suddenly these expectations from about the mid-80s began to get anchored. So one explanation of the 1990s disinflation is, I won't make normative assessments in policy. What I will say is monetary conditions tightened dramatically in the advanced economies. Inflation expectations got anchored, and that contributed to the disinflation. But the second part, and Sajjid alludes to this, is it's the Great Moderation meeting this positive supply shock from globalization, right? If you look at the left-hand side chart, global trade is secularly increasing. This is where China, even before its extension to WTO, Chinese exports are rising very sharply. Right? So you're seeing this positive supply shock where you've got great productivity gains from globalization on the supply side. Right? You see that because US potential growth, these are estimates by the Federal Reserve, jump up in the mid-1990s. Right? And therefore you get, and I agree here with Sajjid, this parallel phenomena where global GDP growth is rising and global core inflation is coming down. That can only happen if you've got a positive supply shock. The supply curve moves out, inflation moderates, growth picks up, right? And so this is a combination of globalization meeting the Great Moderation. What the first implication I have for Sajjid is, prima facie, there are many drivers of this disinflation. One is that there was this huge tech boom in the United States. That caused potential growth to pick up. That was disinflationary. Technology boom, right? There was a big technological boom in the US in the 1990s. Lots of academic papers saying how that was disinflationary, number one. You had Chinese goods flooding the world. Chinese exports picked up. That was disinflationary, but that was embodied mainly through low-skilled labor, right? And then you had inflation expectations getting anchored, at least in advanced economies. Now, your explanation, the USSL, may well have been an important driver in the 1990s. But what I'm urging you to do is, for that decade, control for these other variables. So we can then say controlling for anchored expectations, controlling for the Chinese disinflation of goods, controlling for the tech boom in the US. Here's the marginal impact of high-skilled labor beginning to flood the world, number one. Number two, then we should look at the next decade, the 2000s. And here again, I was quite amazed when I looked at this data because my prior was like Sajjid's, that, well before 2008, inflation was coming down, but core inflation is not coming down. If you look at this chart, advanced economies, I'll show you the next chart, 20, 30 basis points in the post-global financial crisis lower than the pre-global financial crisis. So core inflation is very sticky. And one explanation of this divergence between headline and core is commodity prices. So you just look at the right-hand side chart, you get this huge commodity boom starting, 2002. It peaks in 2008-10, and then it begins to come down the last few years. And if you look at the first chart, I'm going to go back here, that Sajjid showed us. Again, this is mainly to add rigor. You see that in the last part of this chart, it kind of mirrors what's happening to commodity prices more generally, right? So it could be that headline is influenced by that. Now, if you look at the advanced economies and the emerging markets, here's what you find. Pre-global financial crisis, it doesn't prove the data on this chart. Pre-global financial crisis, core inflation in the advanced economies was 1.5%. Post-global financial crisis, it's 1.3%. It's just 20 basis points lower, despite the fact that headline growth in those advanced economies is 50 basis points low. Right? So if anything, the question is, why has core not fallen more? Emerging markets, similar story. Core inflation falls by 30 basis points in the last 8 years versus the previous decade. Growth's a full 1.2 percentage points down. Right? So this suggests to me that slack at some level matters. So, I've provocatively called this page, the Phillips curves, rumors of my death are grossly exaggerated. If you look on the left-hand side chart, again, these are developed markets. Look at developed market unemployment rates and developed market nominal wages. Between 2002 and 2008, somebody had a question about growth being very strong. The unemployment rate falls sharply, and developed market nominal wages are actually rising at that point in time. Then you get the big global financial crisis, the unemployment rate collapses. Now you're getting a tightening of labor markets, and wages have again begun to go up. Maybe not by the margin that we'd expect, and I'll talk about wages soon, but there appears to be a correlation there. Same thing with slack and core inflation. Again, developed markets, the output gap, and we can debate about how to compute these things. This is across 35 countries. Output gaps open up, core inflation falls, output gaps are closing. The last 4 or 5 years, core inflation is picked up. Maybe not by the extent that we expect. So the Phillips curve, so to speak, may be getting flatter, but it's not horizontal. That's the key point here. And the results that we have here are actually very similar to what the World Economic Outlook has last year, where they find, I'll just quote what they said, that the contribution to inflation from targets in the advanced economies, cyclical unemployment and weaker import prices can account for the bulk of the deviation of inflation from targets in advanced economies since the global financial crisis. Kind of what I showed you in the previous 2 charts. But other unexplained factors have been playing an increasingly larger role more recently. Again, that leaves open the role, what Sajjid is saying may well be true, right? That you've got these unexplained factors, but just to say, at least to be provocative, slack and the disinflation that China exerted, that Europe exerted the last 6-7 years, has also contributed to core inflation being below inflation targets. And again, going back to the World Economic Outlook, they too find, they estimate Phillips curves parameters, that both these parameters are alive and kicking in the sense that inflation expectations matter and slack matters, right? So my limited point here is that second kind of implication is, the first was that core inflation is sticky. The second, Surjit, is that at least prima facie, a number of studies have found that slack and inflation expectations can explain a lot of inflation dynamics in the last 8 or 10 years, and therefore, in your models, we need to, and I'll talk to the end, we need to control for this. The third, and this is more a question, I don't have an answer, is if you break down core inflation in the United States, where the data is most reliable, into goods and services, what you find from 2000 is it's really goods that have seen the disinflation. Services have been remarkably sticky if you take away 2009-10. And again, I don't have an answer. It's a question for Sujit's next iteration is, if we say that really it's the high-skilled labor that's flooding the world either directly through immigration or indirectly through the embodied through goods and services, shouldn't we see this more in services which typically have a higher labor component? And less in goods, which are more technology driven? It's an open question. It may not be the case, but just something for you to chew on. And maybe one way is to decompartmentalize core into services and goods and run your variable on either to see if there are differential impacts on goods and services. That might be an interesting one. The last thing I'll say on the global economy is wages, right? Because ultimately the heart of Sujit's argument is wages, that wage growth has been flat, the skill premium has come down. Again, just to kind of look at the data in more detail, what you find is, this is the left-hand side chart from the World Economic Outlook again, that nominal wages have been soft. They came down and they really haven't recovered to their pre-global financial crisis levels. But of course, what we care about is real wages, and that's the right-hand side chart that I construct. And I guess my point is that yes, wage growth has been depressed, but I don't see a secular trend in wage disinflation in the developed economies. What I see, in fact, is between 2001 and 2008, before the global financial crisis, as growth was surging and slack was eaten up, wages actually rise. Now, if one says that the skill premium is coming down, the only way that that's consistent is to then argue that wage growth for unskilled workers is rising very sharply, such that despite the skill premium coming down, the weighted average wage growth is still going up, right? And it is true, however, that wage growth has come down, but so has labor productivity. I think that's the main point I want to leave Sajjid with, that if you look at productivity growth in the pre-crisis period and the post-crisis period, this is in developed markets, it's just output per worker, right? Nothing fancy. And again, we can quibble about the data sometimes. There has been a marked fall in labor productivity. And it's across emerging markets, it's across developed markets. So you look at the right-hand side chart, what you see is both EMs and DMs have seen labor productivity fall. Now, my question is that if we do have this huge injection of skilled labor around the world, that should increase the skill mix of the working population, and prima facie, that should push productivity levels up, not down. So one thing we have to solve for is, why are we seeing in the last 6-7 years labor productivity growth slowing so sharply? The reason this matters for inflation is wages can be coming down, wage growth can be slowing, as we saw, but if productivity growth is slowing in tandem, guess what's happening? Unit labor costs are going up. Ultimately, for inflation, what matters for a firm is unit labor costs. And what you see on the left-hand side chart, this is from the US, is compensation per hour has grown very, very slowly. But that's deceptive from an inflation perspective, because what matters is if productivity growth has also slowed, then unit labor costs are rising more sharply. So the blue line is unit labor costs over the last 20 years in the US. There's no secular trend there, right? It basically comes down in the recession periods, it goes up, in the pre-recession comes down again. Again, a thought for Sajjid, if in fact we do have this huge injection of skilled labor in the world, shouldn't unit labor costs come down? Because what we're arguing is average productivity is going up because of these are skilled workers, and they're depressing wages. Both those things should push unit labor costs up. So again, just something to think about. Now, let me start wrapping up. This means that actually underlying inflation pressures may be higher than wage growth would suggest. We had a CPI number come out of the US day before last night, so I used it here. Again, I don't want to overinterpret one data point, but the fact is core inflation in the US is now back above 2%. It's at 2.1%. You know, there are base effects at play. You've seen the top right-hand side chart. It goes above 2, it comes below 2. The momentum, bottom right-hand side chart, 3-month on 3-month, seasonally adjusted annualized, is running at 2.9%, is the highest since 2007. Open question again. Core inflation has been creeping up. As unit labor costs go up, are inflation pressures re-emerging, at least to some extent, in the United States? Let me start wrapping up. So here is where I actually, I'm completely with Sajjid. But you see, what you're also observing, and this goes to Sajjid's point, is the profit margin of corporates is still abnormally high at this stage of the business cycle. These are US corporates. We're in the 9th year of the business cycle. Normally at this point, what you see is corporate profit shares begin to fall because two things happen. By the 8th or 9th year, unit labor costs go up because at the margin, wages are rising and the marginal worker late in the expansion is less productive. And secondly, interest rates are going up. What you see here is, in fact, corporate profits are unduly high. This would actually support Sajjid's hypothesis, which is that, you know, wages are still relatively depressed to productivity, and that is why you're seeing corporate profits being high even at this stage of the business cycle. The only wrinkle I will add over here is that also monetary conditions are exceptionally accommodative. Interest rates are exceptionally low. That also helps corporate profit shares. But prima facie, Sajjid, this is the chart that, you know, goes to your hypothesis. So let me then propose my kind of last chart on the global economy that Sajjid, restate the problem. The problem should not be that in the last 20 years we've seen this great inflation decline because we saw it in the 1990s. We haven't seen it then. The problem that Sajjid should restate it to say, look at this chart. The unemployment rate today is at its lowest level in almost 40 years amongst developed markets, the yellow line. It's an inverted line. So the higher the yellow line, the lower the unemployment rate in developed markets. It's much lower than the peak of the 2006 business cycle, much lower than the peak of the 1980-98 business cycle. At these levels of full employment, with such little slack, we should have seen higher core inflation. So I would Sujit, rephrase what you're saying and say, don't try and use it to justify the great inflation decline. Rephrase the problem to say there is a natural cap on wages such that wages and core inflation are out of sync with slack, and therefore corporate profits are high, and in a way that will provide more kind of justification. So to put it all together, here's my summary. Core inflation slowed sharply in the 1990s, but it has remained very sticky after that, number one. Number two, I would argue in some of the work I've done, some of the work the WIO has done, that core inflation is still not immune to output gaps and slack, even though the Phillips curve may have flattened. Number three, there's been no secular decline in wage growth or unit labor costs over 3 decades, as USS would imply, so I would urge Sajjid to think more about that. And fourth, yes, wage growth has slowed, but since the global financial crisis, so has labor productivity. And so that itself would explain some of the slowing in wage growth, such that unit labor costs are rising. What are the implications? This comes to the point of, is inflation dead? Well, a lot of what Sajjid was saying was globalization. Now, what we've seen is, at the margin, countries are going back to autarky, much more protectionism. We've seen a very strong anti-immigrant feeling in Europe. We've seen, the US and China threaten some kind of trade war. So one open question is, if protectionism were to rise, will it reverse either directly through low immigration or indirectly through goods and services some of this disinflationary impact of the unlimited supply of labor? And the second is, as I've shown, that some of the disinflation is because of slack. So as slack continues to erode, are we going to see a little more inflation than we all thought? And we are already seeing that in the US. Let me just say, one scary thought for emerging markets is on this chart is the unemployment rates at 40-year lows. But look at where policy rates in emerging markets are. Normally, the yellow line and the blue line should move together. When unemployment rates are so low, policy rates are 300 basis points higher than where they are today. Now, technically, one could argue potential growth is much lower, so R star should also be 100 basis points lower, but that still means advanced economies will have to raise policy rates by almost 200 basis points, given where slack is. The Fed has signaled that. The Fed signaled 2 weeks ago it plans to raise rates 3 times in 2017, 3 times in 2018, and they were one vote. I guess this doesn't like tighter monetary policy, does it? Thank you. They were just 1 vote away from signaling 7 rate hikes. So the Fed is telegraphing and telling you we have to raise rates 175 basis points. That's just not relevant to Sajjid's analysis, but we better start getting used to the fact that given how low slack is and given the momentum of core inflation, monetary conditions will not be this easy forever. My last point, therefore, is suggestions on Sajjid. The next chart is on suggestions on the next stage of the analysis. So Sajjid, number one, I would suggest use core inflation, not headline. And why don't you, to satisfy the critics, just use this augmented Phillips curve approach, where you control for expectations, you're controlling for slack in advanced economies, because you see the output gap doesn't matter, and then controlling for those things, use your variable of USSR. Number three, look to see if there are structural breaks, because the experience of the 1990s and the 2000s is very different. Number four, why not use USSL directly on wage growth, not just on the skill premium, after adjusting for labor productivity. We have this data for advanced economies. Number 5, split core inflation into goods and services to see if there are differential impacts. My very last thought provoked into speaking about India. I'll turn to India to try and kind of plug my own paper on this topic. It was written about a year and a half ago, actually. It's an IMF working paper trying to understand the causes of disinflation. Firstly, let's agree on the facts. Sajjid and I completely agree. Average inflation between 2006 and 2013 was 9%. You've seen a dramatic disinflation. It's been across food, it's been across core, this is broad-based. So really the question is what's driven it? And I've only, in the interest of time, I only have my main table. By the way, you know, it does explain on a year-on-year basis 96% of the decline. So I'm going to, so too many numbers here. Let me tell you where I agree and where we disagree. Where Sajjid's model and our model agrees, MSPs do matter. MSPs matter undoubtedly. We actually find the output gap matters. So we use quarterly data using the old CPI IW from 2002 and in 2015. We use the HP filter for GDP growth. We can discuss that offline. And we do find that the output gap matters. Now, in terms of, I think where we differ is the following. There are lots of lags of past inflation here, primarily to take to control for serial correlation. Because without those lags, your Durbin-Watson is nowhere close to 2, so there is serial correlation. We have 8 lags out there, because also I would argue without these lags, given the way MSPs are set, which are backward-looking, the costs of last year matter in MSP setting for this year, and wages also, which were indexed to NREGA wages, which were also backward-looking, looking at last year's inflation. There could be a lot of reverse causality between MSPs and wages on inflation if we're not controlling for serial correlation. So we have the 8 lags of inflation. Many of those lags are very significant. So we find the output gap matters, lags matter. I take the lags to be a function of inflation expectations, which are very adaptive. The process is very persistent. We find MSPs matter. What we find different from Sajjid is wages don't matter. Wages matter if I don't control for lagged inflation. The minute I put 8 lags in, wages become insignificant, suggesting that wages are more an outcome of previous inflation, to your question. They're reflecting past inflation rather than providing new information on inflation going forward. But it's a minor quibble. So I think broadly the results are similar, with the exception that the output gap is positive and wages are not. But I've gone on way more than I have to. But let me end by just saying, you know, despite my quibbles and suggestions, fabulous book, a must-read for everybody, very thought-provoking, and I think a rich source for making this an academic paper. So thank you, Sajjid, and thanks for having me here.
So that brings us to the end of the 2 formal presentations. We have about 10 minutes for some Q&A from the floor. But at the onset, let me, one word of caution from the microeconomist on the panel. Regressions with 24, 27 observations are always a little scary to people like me, but I suppose the terms of engagement are a bit different when it comes to cross-country macro regressions. So those of you who want to ask a question, please identify yourself and ask away. Yes.
Sir, you have described about the parameters which are related with the, man-made sort of. But there is a natural economic cycle, like deflation, stagflation, and it continues for, let us say, 24 years. Have you taken those into account? I'm just asking because I have not read your books. Then the urbanization is a very big subject, because even in the rural, if that zone has become industrialized, that is an urbanization. So how far direct payment, now all these things, urbanizations, infrastructure building, and the global connect is again a man-made. So how many things have been taken into your charts? So that's my question.
Anyone else? Yes. Please pass the mic.
How do you see inflation if the global oil prices remain above $100 per barrel for next 10 years?
Hi, my name is Manas. I'm an entrepreneur. Just quick question: what is the relationship between inflation and if there is any coming recession or depressionary things that are going to happen. What's your take on that? Thank you.
Do you want to take those three while others think? Yeah.
And then I want sometimes, yeah, some very, very good points made. But look, the natural economic cycle and urbanization, all of that is embedded in the equation. And all of those, mind you, both urbanization, skilled labor, which I talked about, as well as infrastructure, all of these things will go towards lowering inflation in the emerging economies. So there isn't actually any factor that I know of that will lead to an increase in inflation. Now to the point about oil. As I said, we don't know whether oil will go back to 100 or not, but what we've seen is the last time it went up to 100, actually world inflation came down. So I think it's a very spurious correlation that people make between oil and overall inflation. And I think that's it.
Yes, TCA. Could we get a mic here, please?
Oh yeah. You know, we lost the recession is now going to be or likely be, as we've seen, other than 2008 and 2009, much more about a slowdown in growth rather than negative growth. In the emerging world, you don't have a recession as classified as a decline in real output. You have a decline in growth, so you can have a growth recession, and that is part of nature. Whether you will have the recessions of the kind, what you see in the last 30 years, there have been only two recessions. And one of them lasted only a very, very short time. But a decline in rate of growth, yes.
TCA?
So just let me flag a slightly different, something which I've been puzzling for a while. It goes back to what you said when we were students, what we were taught about inflation and what are thresholds of where inflation should be and the role of friction in determining inflation. Sajjid made this lovely thing, but what comes out, regardless of which way you cut it, inflation is well below what, when we were students, we were taught. We would have said, look, this is in the boundary of zero, this is noise, this is not inflation. So the question I want to pose to you is, what is the nature of friction in the economy? And in a sense, friction has come down because globalization is only partly telling you the story where friction has come down. The huge boom which we have seen since 1980 or ICT is really what is the story which we are missing in this, which is bringing down friction in transactions. I don't have a good metric of measuring it, but one way to do it is to look at variability sub-regionally. You know, we are looking at national averages, but maybe it might be better to look at what is the quote-unquote variability sub-region. The question is going to be a data challenge. Probably the US, we may be able to do it, so it may be worth looking at it from that viewpoint. But I really think we are still looking at a very different world, and where I agree with you completely is I think the macroeconomists are still analyzing with the models of the 60s, which are irrelevant.
Thank you. That's a good suggestion for looking at variation across regions. Anyone else? Rashid?
Thank you. I also was thinking of your 2% being the friction rate, and I was also a student in the 70s, so I remember what the inflation expectations were all about. And it just struck me that when inflation expectations fall, maybe the inflation rate linked to friction also falls down. So one thing, and I agree with Sajjid that I think that when you ask the question, is inflation dead? Or if you have in your mind that, you know, the high prices or increase in prices, that era probably is behind us for the moment. One doesn't see the major future, especially if there's a conflict in the South China Sea. But
at the same time, what I've been thinking about is that the number of factors which affect inflation is far many more than what probably you have looked at, and Sajjid has pointed out several of them. The other aspect is that perhaps because the downward pressure due to China and some of the other large presence in global system is such that there is pressure downwards, maybe there is an asymmetric impact of the variables which we earlier thought was, you know, in some sense, a very straight linkage. For instance, maybe when the oil prices go up, the other factors impact swamps the effect of the increase. But when the oil price comes down, it actually adds to the inflation coming down. I would think, and I haven't had the benefit of as detailed information on output gap as Sajjid has got, that perhaps the output gap also has the same kind of asymmetric relationship. So what has happened is that overall inflation level has come down due to these factors. Maybe the core inflation rate will remain where it is, but the variation from that core is not going to be too much unless it's coming downwards due to some factor or the other. So yes, inflation as we knew it is dead, but inflation in the new paradigm is still alive and kicking and perhaps can give you a few kicks along the way. That's the way I see the situation.
Great, thank you. So now we have 2 minutes. Sajjid, if you want to respond.
You know, 2 minutes is too little time to do justice to
3 then.
the questions as well as the very, very elegant and correct presentation of Sajjid's. You know, let me, and again, there were a lot of pointers, and I'll get your suggestions both offline and through this. You know, when you say that sticky, and your point, are we now in the realm of explaining noise? You remember, it stayed at 2, it goes to 2.2, 2.3. You know, the CPI has come to 2.1 from 1.7. I mean, this is noise. So the secular trend, first of all, the stickiness is all around 2, from 2.3 to 1. You know, I mean, gone are the days when inflation was, you know, 100, 200, 300 basis points. This is the 10th. This is how the world has really changed. And, you know, a lot of the, take for example, services inflation. Now, we don't have, now there is a banking service index that is an experimental one, which is systematically going down at about 3% a year in India. Okay, banking services. Then you have telecom services. I mean, I don't know what is there to cause inflation. Inflation is a sustained price, a sustained increase in the price level. I'll tell you where I think, and I mentioned this in the book, where we are at. In the 60s, or 70s rather, there was an economist, and I forget his name, but there were 2 or 3 others. But, you know, I began to study economics only in the 1970s. But what struck me was his observation that prior to 1945, the world had price stability and inflation instability. So the price level was 100 for hundreds of years, gold price index or whatever it may be, and you had inflation instability. Sometimes 10% inflation, sometimes 20% inflation, minus 20%, etc. And he said, with the Keynesian era, what we are getting into is inflation stability at a low level, or 2% or 3% or 4% level, and price instability. Where we are for the last 20 years, you know, China has an inflation below 2%. I mean, you know, India is, if you correctly measure, mind you, let's come back to India for a moment, that the whole CPI is based on the 2011 base, and the 2011 base has a food share which is much higher than the actual food share. Okay, so the food share should be about 28%, it's 46%. and so on and so forth. If you do the correction, which I've done, which I submitted to Raghu when he was the RBI governor, that really it's about 50 to 150 basis points lower. So what we are talking about, India, the Indian inflation today is somewhere around 3%. 3%. You take core, you take non-core, if you take banking services, you do all, you know, what is the pressure causing inflation? Last, expectations. You know, notice in my book, I don't talk about inflation expectations, and that's very deliberate. That's a mug's game. That is absolutely a mug's game. And I'll tell you how it is a mug's game. Okay? Take our own great RBI. They started an inflation expectation survey of households back in 2006. And for 2 years, they got it right. And now, and including the latest policy statement, they note inflation is collapsing, but inflation expectations are going up, and by an order of magnitude. It's 9. I mean, it's garbage. So they have reduced themselves to, correctly, thankfully, to looking at what you guys say. The Professional Forecasters Survey. And what do you guys say? You look at the weighted inflation of the last year, 2 years, and you predict. I mean, it is, you know, so I don't think it's an exogenous variable at all. I know that the IMF, you were at the IMF, you know, I mean, it's a mug's game. It's nonsense. Rather, the questions that you raised, okay, those are substantive. And I think the productivity one, and what I'll just quickly give an answer, whether the inflation in services or goods, those are the things we should be looking at. And unfortunately, the data is not there for the countries. If you can supply me with all this or find me where it is, and wages. You have good wages data on the Western world, but the US, the reason I consider the US is you've got the maximum data there. But inflation, I'm not going to go into that trap because, you know, it just, and I think I would encourage you to get away from inflation expectations explaining anything. It's circular. Because unless you have an independent, you know, model of inflation expectations, which is other than the actual inflation. So therefore, what a lot of people do is use a weighted distributed lag. You've done it, and, you know, and that's correct. I mean, but then you're not, that's past inflation. So that's why you have past inflation in the model to take care of so-called inflation expectations. I had one more. So I think one is the inflation is dead, and you and I completely agree. You say it's sticky at a low level. To me, that's the same. I'm not interested in inflation being 1.6 or 2.1. Okay, I mean, to me, it's noise. I've done enough empirical analysis to know that run a million regressions like Salamartin to know that it's just pure noise. But it is sticky at a low level. I agree. I don't think it's going too many places. So that is when I say dead, and I think I make it specific. It's not zero. It can't be zero. But I do think the trend is going down because everything that I know or that I can study points to lower inflation. And it's distributed now. And when you have large economies like China and India inflating at 2-3%, which was something unheard of, and not to mention Korea, not to mention Brazil, is what, 2% now in Brazil? So we need to answer, where is inflation going to come from? Last, on this whole oil thing, I agree, you know, oil prices going up, something, but, you know, we are stuck. And remember, when we had oil prices going up by the fastest rate of increase, that's when you had the biggest decline in inflation. Yeah, yeah, yeah. So we are now unlimited low inflation.
Okay.
Thank you.
And for that, he wants 30 seconds to just respond.
No, I agree with everything Sajjid said. We'll take it offline. I think the only point here that came up through the questions was inflation being stuck at a low level. Why does that matter? And I think there are two different questions here. One is statistically it may not matter. 1.5 and 2.5 may be part of the same underlying distribution. But if it gets stuck at 1.5 versus stuck at 2.5, US inflation, for example, it matters hugely for central banks. 1.5 inflation for the next 10 years in the US versus 2.5 inflation is a 200 basis point difference in the FOMC rate. And for economies, policymakers, markets, asset prices, that has huge implications, right? FOMC rate that's a 150 basis points higher means growth outcomes around the world, asset prices, exchange rates, monetary conditions for emerging markets in India. So while the big battle has been won, we've come from 7 to 6. I think it's our profession's job now is to figure out, will we get stuck at 1.5 or at 2.5, 3%? Because that will have huge implications for developed market central banks around the world. And I think that's why that question is still economically meaningful.
Thank you, Sajjid, for a very thought-provoking presentation, new ideas to mull on, and thank you, Sajjid, for a very, very thorough discussion. I think many of his comments can actually be incorporated to sort of refine further. You're welcome to send it to us. We'd be very happy to also review it. Thank you all for participating. We have some coffee and some snacks at the back. Thank you.